Okay, let's dive into the story of how a regular old video game store basically became a Wall Street battleground. I mean, it is a wild tale, right? You've got social media, powerful hedge funds, and everyday investors all colliding in this financial frenzy that honestly captured the world's attention. And it didn't just stop there, it landed its key players right in front of the US Congress. And this quote right here from the congressional hearing that happened after all the chaos, wow, it just perfectly captures the tension, doesn't it? See, for so many people, the GameStop thing wasn't just about a stock. No, it was about fighting back against a system that just felt, stacked against them. All right, so let's set the stage. Our story really kicks off with GameStop, a video game store we all know. But here's the thing, this company was also a target. You had some of Wall Street's most powerful investors betting that it was going to fail. And that's what turned it into this unlikely epicenter of a massive financial fighter storm. And these are the main players, the four guys who ended up having to testify before Congress. You've got Keith Gill, the retail investor, you probably know him as Roaring Kitty Online. Then there's Gabriel Plotkin, the CEO of the hedge fund that was betting against GameStop. Next up, Vladimir Tenev, the head of that super popular trading app, Robinhood. And finally, Steve Huffman, the CEO of Reddit, which is, the platform where this whole thing just blew up. Okay, so now we get to the real heart of the conflict. This entire saga, it all started with two completely opposite views on the very same company. On one side, you had these Wall Street pros just looking at it and seeing a failing business. But on the other side, you had this growing online community that saw a massive hidden opportunity. So to really get what's going on in this battle, you have to understand the main weapon one side was using: short selling. It's basically a bet that a company's stock is going to go down. And in this story, hedge funds like Melvin Capital were placing huge bets that GameStop was on its way out. And here, you can see those two clashing stories right next to each other. The bear case from firms like Melvin Capital was pretty straightforward. They thought GameStop was just a dying brick-and-mortar store getting crushed by digital downloads. Simple. But the bull case, the one that Keith Gill was pushing, saw something totally different: an undervalued company that had a real shot at reinventing itself. And here you have it, straight from Gabriel Plotkin himself, telling Congress his logic. For his firm, see, this wasn't some random gamble. This was a bet backed by research, a bet that GameStop's entire business model was just obsolete. But then, on the flip side, you have Keith Gill's point of view. He argued that social media was leveling the playing field. Regular people, individual investors, they were using platforms like Reddit and YouTube to share a totally different analysis. They were convinced they'd found a golden opportunity that Wall Street had just completely missed. And then January 2021 hits, and this whole debate just explodes. The stock goes completely wild, the internet is cheering, and then, all of a sudden, the buy button disappears. Just like that. The game got stopped. I mean, this was fueled by a buying frenzy that was mostly organized on Reddit, on the Wall Street Bets community. And the stock price? It just went absolutely vertical. We're talking a surge from around $17 at the start of the month to a staggering peak of $483. Insane. But right at the absolute peak of this frenzy, everything came to a screeching halt. Popular brokers, especially Robinhood, suddenly restricted people from buying any more shares of GameStop. You could sell, sure, but you couldn't buy. And that move, as you can imagine, sparked immediate and widespread outrage. Eventually, Robinhood's CEO, Vladimir Tenev, he came out and apologized. But let's be real, that apology didn't do much to answer the main question on everyone's mind. Why? Why did they do it? Was this some kind of backroom deal to protect the hedge funds that were losing billions of dollars? Well, Tenev's answer wasn't some grand conspiracy. He said it was basically a plumbing issue, deep inside the financial system. He blamed something called clearinghouse deposit requirements. You can think of it like a security deposit. Because the trading was so insane, so volatile, the clearinghouse suddenly demanded billions of dollars in collateral from Robinhood, overnight. He claimed that restricting buying was the only way they could lower that risk and actually meet the demand. So, as you can probably guess, the fallout from that trading halt was huge. It led directly to Washington, D.C. Congress wanted answers, and they called in all the key players we talked about to explain, under oath, exactly what went down and why.
Okay, so one of the biggest accusations was that this whole thing was done to save the hedge funds, right? But Gabriel Plotkin from Melvin Capital, he testified that his fund, even though it lost billions, had already gotten out of its GameStop position days before Robinhood and the other platforms ever put those buying restrictions in place.
And then there was Ken Griffin. Now, his firm, Citadel, was in a really interesting spot. They had not only invested money into Melvin Capital, which was struggling, but they're also the market maker that executes most of Robinhood's trades. So you can see the conflict, right? But despite all that, he flatly denied having anything to do with Robinhood's decision. Next up was Reddit CEO Steve Huffman, and he really came to the defense of the Wall Street Bets community. He testified that their own analysis found no evidence of bots or foreign agents messing with things. He argued that this was a genuine, organic movement that brought up some really important questions about fairness in our financial markets. And then there's this quote from Keith Gill, which it captures the heart of the entire retail investor story. In what became a super famous line from the hearing, he made it crystal clear, "I am not a cat." He wasn't a hedge fund, he wasn't some big institution, he was just an individual who believed in his own research and decided to share it online. But you know what? This story didn't just end with that hearing. Not at all. Because for the many, many investors who kept holding the stock, the whole reason for being in it started to shift. It went from being about a short-term squeeze to a real long-term belief in the company's actual value. And this is a really crucial point. At first, the idea was to trigger a short squeeze, force the hedge funds to buy back all their borrowed shares at a much, much higher price. But over time, that idea kind of morphed into something else, a genuine long-term belief in the company's fundamental value. And if you go back and look at Keith Gill's original analysis, which a lot of people on Reddit did, you see it was always a two-part idea. Part one, for sure, was the squeeze potential because of that massive short interest. But part two was a fundamental belief that GameStop could actually turn itself around and succeed. This post here from the r/superstonk subreddit, well, it puts it a little more bluntly, but it perfectly captures how people were feeling. The idea was that for the true believers, the squeeze was never the main course. It was just the cherry on top of a deep value investment. And all of this leaves us with this one big lingering question, right? Was the GameStop saga just a chaotic, one-time flash in the pan? Or was it the first major battle in a completely new era, one where social media and everyday investors have permanently shifted the balance of power on Wall Street? The original game might have been stopped, but it feels like a brand new one has just begun.